Thanks for joining us on Power Lunch. This is Bloomberg Quint and I'm Ira Dugal. Let's get you the headlines. Indian markets managed to hold on to gains as the HDFC Twins and Tata Motors moves higher. The renegotiated Rafale deal in 2015 was cheaper than the 2007 one, opines the Comptroller and Auditor General of India. Ericsson accuses Anil Ambani and Reliance Communications of a willful act of contempt. RCom argues that the undertaking to clear dues was subject to the deal with Jio being closed. Bhushan Par's Committee of Creditors rejects the promoter's last-minute attempt to come back into the deal. JSW picked as the winning bidder. Bond yields fall below 7.30 as a lower-than-expected CPI print prompts speculation about more rate cuts. Let's first take a look at the equity markets. Yatin is here with us. Afternoon.
Good afternoon, Ira, and we are holding, that 10,850 mark on the Nifty. However, if you look at the market breadth, it's almost two stocks gaining to three declining. So the market breadth is clearly weak in trade today. We have also come off from the day's high. However, if you look at the markets, stocks like Adani Ports, Indiabulls Housing Finance and UPL are doing quite well in trade. In fact, Adani Ports is zooming 5% up for that stock on huge volumes, mind you. On the contrary, we have stocks like HPCL and BPCL from the oil and gas pack, which are declining in trade, 3% down for each of them. Z also has been facing some selling pressure today, was as low as 7-8% in trade, has managed to recover from the day's low significantly, but that stock is under pressure, and so is Eicher Motors, clearly trading at 20,600 mark, 2.5% down for that one. The stock in focus would be Crompton, Crompton Greaves, which is now CG Power. That stock is down 20% after the company disclosed that they will have to probably write off, debtors worth almost 100 crores, and probably post that disclosure, the stock has fallen almost 20%, trading at the day's low, and so is Dish TV, 5% down for that mid cap.
Thanks so much for that, Yatin. That's the equity markets. Let's check in on the bond markets as well, responding to a lower than expected CPI print. The new 10-year bond yield is back below 7.30, in fact 7.27 on the 10-year bond. Now, just to give you a sense of what came through in the CPI number and the talk doing the rounds in the markets, you got a headline number which was at just above 2%, 2.05 if you want to bicker at the second decimal point, but at 2% you're at the bottom end of the MPC's target band, which is 4 plus minus 2%. Now, until before the February policy, the debate was that, yes, headline inflation is falling because of food prices, but core inflation remains high. What will the central bank focus on? That debate was put to an end at the February policy when the governor very clearly stated that the MPC is looking at the legal mandate of targeting the headline inflation number. So if that is the case, then of course the question is how much can the MPC actually cut rates by? They've already done a 25 basis point cut in February. They are on a neutral stance, which means that more rate cuts could be in the offing in April. Some people have started to raise the question as to whether that rate cut could be of a larger degree than just 25 basis points, meaning could a 50 basis point rate cut be in the offing? Soumyakanti Ghosh, Chief Economist at State Bank of India, is among the people who are raising that question. And in his report, he said that the April rate cut might be of a quote-unquote larger magnitude. He joins us on the phone line. Mr. Ghosh, good afternoon. Let me first ask you what lies behind that call that the April policy will not just bring a cut, but a cut of a larger magnitude.
Yeah, I think the time has now cut for front-loading. The time is now opportune for having a front-loaded rate cut. It has happened in February, and there is no reason why it could happen in April of a larger magnitude, because all conditions and all our projections are now showing that the inflation numbers could be significantly below 4% or around 3% for a large part of 2019 as of now. So if that is the case, there is no reason to keep on hiking the rates in baby steps, maybe in April, and then take an assessment of how the monsoon behaves, and then again in August, because that is not going to serve any purpose. So my sense is that you need to front load a rate cut aggressively in the April policy, which is the annual policy, and then see how things pan out.
Mr. Ghosh, so, your read into the numbers suggested that not only is the lower food inflation or food disinflation persisting, but even core inflation is starting to come off?
Yes, core is starting to come off, and if the numbers of yesterday's rural and education and health is any indication, I believe that if the February numbers are also doesn't show any increase, that means that the September and the December numbers were an data error possibly on the part of CSO. Otherwise, the number by now would have been, the core would have been below 5%. So at this rate, the February core should drop decisively below 5%, and rural health, and I assuming now that the rural health and rural education was possibly a blip number which came out for whatever reason. And if that is the case, and if inflation in February also remains decisively below 2.5% and now 30 to 40 basis points below the RBI estimates of 2.8%, I don't see why the rate cut cannot be of a larger magnitude.
Mr. Ghosh, I think food inflation is what continues to be the big story. Now, there has been a little bit of a sequential pickup, right, on a month-on-month basis on some items like vegetables, which had been depressing the headline year-on-year index.
Yes, but that is acting very insignificant, because if I look into the numbers, whatever we have been calling about on food inflation breaking through the comfortable barrier now for the last 2.5 years, then it has not broken through. And every time we give this argument that food inflation is going to break through, we have a positive surprise. So I think instead of waiting for that pickup to happen, which could happen, I think, and if it happens, that will be good also for the economy, because at these low rates of food inflation, that is not a good indicator. So my sense is that instead of waiting for that time to happen, why not use this opportunity and use the current opportunity to go for some sort of an aggressive steps? Because remember that all of us were expecting that there could be a rate change stance and possibly a cut in April, but the Reserve Bank did the correct thing by doing this both in the same policy. So I think we should not keep our past baggage. We should leave aside our past baggages and think afresh. And there is no reason to believe that if food inflation, even if it shows a marginal uptick, there is no reason to believe that why there cannot be aggressive steps to counter this, some sort of a deflation which has now been going on for a while.
All right. Mr. Ghosh, last question to you. We all start looking at the month-on-month numbers and we forget just how dramatically the inflation picture has changed in India over the last 5 years. Hopefully you will write a report on this as well. Are we now entering a period where, say, the peak rates of interest rates in the economy will be much lower if one assumes that we've managed to, at least at the headline level, contain inflation to, say, a 4 to 6% band, even if you go on the upside? But those peaks of inflation and hence peaks of rates that we had seen in the past are something that we've forgotten for now?
No, I think the peaks we should have forgotten. And just before we end, I think the interest rate at this inflation continues to surprise. And I think the peak rates of inflation we had of those 9%, 9.5%, they are now thing of the past. And interest rate mostly will remain largely stable. The only point is that the government borrowing program, which is of a larger magnitude, so that could limit and significant fall in the interest rates. But as of now, if I take the contrarian argument, a large government borrowing could have actually resulted in a higher interest rate, which is not happening. So that's the positive thing. Of course, the downside is that it may not have significantly declined given the size of the borrowing program. You should also take the example of the U.S. economy, whereby the U.S. economy will have a debt of 22 trillion. Even then, the U.S. economy is growing at a rate of 3.7%, and inflation has been consistently surprising on the downside, thanks to a dovish Fed policy time and again. So maybe I think there could be some time to emulate some of the actions in the near future.
All right, Mr. Ghosh, thanks so much for joining us. That's Soumyakanti Ghosh on the inflation numbers and the impact it's having on bond markets this morning. Let's move on. The big story from New Delhi, the Comptroller and Auditor General of India has submitted the report on the Rafale deal in Rajya Sabha today. The government auditor has prima facie found that the renegotiated deal of 2015, which includes India's specifications, was marginally cheaper. It's important to note that the exact pricing has not been mentioned in the report, as the Defence Ministry maintains that those details cannot be disclosed. Ian Marlow of Bloomberg News now joins us. Ian, what are the key highlights of that report, which has now been tabled finally?
Yeah, as you mentioned, the key highlight here is that the deal negotiated under the Modi government is roughly 2.86% cheaper than the previously negotiated deal under the Congress government. And obviously the government has been under fire from Rahul Gandhi and other opposition parties with relation to the deal, whether it was more expensive on a per jet basis and all these other things. So this report will go some way to relieving pressure on the government ahead of the elections, obviously, because they've been under fire on this deal particularly. The report has some other stuff in it. Frankly, it's a very confusing report, and there's also no kind of real figures in there, so a lot of people are sort of guessing at the moment, and especially there's been all these revelations lately in newspapers like the Hindu and the Indian Express with new details and leaked documents. So everyone is sort of looking at all these different things and trying to compare different figures and figure out what's the truth here. But at the moment it looks like the government can go to the public and say, look, this deal was cheaper than the previous one. So on that main accusation, the government can dodge the bullet. And then there's also a couple of paragraphs in there that say the deal will actually deliver jets faster. But after a sort of 72-month delivery period, it's sort of a 1-month bonus. So I'm not really sure that bolsters the government's case on delivering the jets faster. So at the moment, it's still a bit of an open question on whether the government can take this report and use it to defend themselves against all the allegations that are coming at them from a lot of different angles at the moment.
Alrighty, and thanks so much for that update. We will, of course, continue to get you more details and more implications of that CAG report on Bloomberg Quint. Let's move on. Arguments are on in the Ericsson's contempt plea against Anil Ambani and Reliance Communication. Ericsson has alleged a willful act of contempt by Reliance in not clearing the 550 crore dues to the telecom infrastructure company. Arcom argues that the undertaking was subject to the deal with Jio. Arpan Chaturvedi joins us on the phone line. Arpan, what has transpired so far? Arpan, if you can hear us, what has transpired in the Ericsson Arcom case so far in the courts today?
That's right, Ira. So the arguments on behalf of Ericsson was started by Senior Advocate Dushyant Dave, who said that the undertaking given by Arcom was an unconditional undertaking that which basically says that they made a commitment that they will pay the rupees 550 crore that was due to Ericsson, and on their part, Ericsson says that this is a willful act of contempt. From day one, they had no intention to pay the money. And its reply, Arcom was represented by Senior Advocate Mukul Rohatgi, who said that first of all, it is a listed company, so the dues of the listed company cannot be paid by an individual. Remember, Ericsson has also made Anil Ambani a party in the contempt case that they have filed. Mr. Rohatgi also said that it is incorrect to say that it is an unconditional undertaking. What Arcom stance is that this undertaking to pay the money was dependent on the Jio deal with Reliance Jio going through, and now that has not happened. On their part, Arcom has said that they have made every single attempt possible for this deal to go through. They have approached every authority, including the telecom ministry, the Supreme Court, to get the no objection certificate for the deal. And in the end, now that has not happened, and therefore they have no other option but to go for insolvency. And now what Arcom stance is that the fate of Ericsson and all the other operational creditors as well as others will now have to be subject to the insolvency petition or the insolvency proceedings that they want to go forward with.
All right, Arpan, thanks so much for that. Sources tell Bloomberg Quint that the Committee of Creditors for Bhushan Power has declared JSW Steel as the winning bidder, essentially rejecting the last-minute proposal by the erstwhile promoters. Vishwanath Nair reports.
Despite considerable judicial delays and the last-minute plan by Bhushan Power's promoter, JSW Steel has managed to back the asset with a winning bid. According to what sources are telling us, the lenders to Bhushan Power and Steel, the Committee of Creditors has sent out a letter of intent to JSW Steel, offering all the assets of the company in lieu of the 19,300 crore offer that JSW Steel has made. Now, this 19,300 crore will be paid upfront to all the financial creditors in Bhushan Power and Steel, Steel. Remember that their dues are close to 47,000 odd crore. For the operational creditors, JSW Steel is offering another 350 crore as opposed to their claims of about 620 crore. So in both creditors' cases, financial as well as operational, they will be taking a certain haircut. However, lenders said that this is better than what the promoter had proposed to repay the lenders over 17 years using a CRPS scheme. So according to the lenders, an upfront payment makes more sense in the current environment. Remember that this case has seen considerable delays because of litigation by Liberty House, who was the second highest bidder in this case, as well as Tata Steel, who had challenged JSW Steel's revised bid in the case. Both these litigations were put to rest by the National Company Law Appellate Tribunal later on in the hearing. As well as the promoter of the company, Sanjay Singhal, had challenged the constitutional validity of the Insolvency and Bankruptcy Court at the Supreme Court. However, the Supreme Court upheld the constitutional validity and said that Sanjay Singhal's challenges were dismissed in the matter. Now, the Committee of Creditors and the Resolution Professional for Bhushan Power and Steel will be filing the papers with the National Company Law Tribunal for final approvals for this deal. And once that comes through, then the transfer of assets can move on.
All right, staying with banking briefly, the Reserve Bank of India has penalized 5 banks for not adhering to guidelines on monitoring the end use of funds by borrowers, exchanging information with other banks, and classification and reporting of frauds and restructuring of accounts. A 1.5 crore penalty each has been imposed on Allahabad Bank, Bank of Maharashtra, Indian Overseas Bank, and Oriental Bank of Commerce. Andhra Bank has been served a 1 crore penalty. Remember, last week, State Bank of India too had received a 1 crore penalty notice for not monitoring the end use of funds in a particular account. Let's move on to news just coming in. Apollo Hospitals promoters Pratap Reddy and family may be looking to sell their stake in their insurance venture. The family, which collectively holds about 40%, is planning to use the funds to repay debt. Ganesh Nagarajan of Bloomberg News, who broke the story, now joins us. Ganesh, what do you have?
Hi. We come to know from market sources that the Reddy family are planning to sell their stakes because they had to increase the pledging of their shares in Apollo Hospitals Limited to repay KKR, from whom they have taken a loan of 550 crores some 5 years ago. So they have increased their stake now, and they are looking to sell their stake in their insurance arm, which is in partnership with Municari.
All right, and this is in the context of the group's overall debt burden?
Yes. Mostly yes.
All right. Ganesh, thanks so much for joining us with those quick takes. We will, of course, read more about that story on BloombergQuint.com. Higher realizations and good cost control helped Coal India report an operationally strong quarter. Nikki Mirchandani is standing by with the key highlights. Nikki.
Thanks, Ira. Well, good set of numbers delivered by Coal India, pretty much in line or better than what the street was estimating. Operationally, it was a big beat, which was delivered by the company yesterday late night. Top line, 15% uptick there. Margins expanded to 27% as compared to 21% in the corresponding quarter. Profitability rose more than 50%. And in terms of volume, we saw a good amount of volume growth in FSA volume on account of higher push to the power sector. E-auction volumes were higher by as much as 44%. Total volume, as the figure was already disclosed, is a flattish growth. So on a flattish growth, you get an EBITDA of more than 45-50% for the company, which is a stellar number coming in from the companies, mainly driven by the beat that we saw in from the FSA and the e-auction realization. E-auction realization, it was clearly the price hike that was delivered by the company effectively in Jan 2018, which percolated well on the financials of the company despite the dip in the volumes that we saw. Overall, all the brokerages net have pretty much maintained their kind of stand on the company, be it in terms of the outperform rating or the buy rating. However, they've gone ahead and slashed the target price for the counter, given the limited scope that the company has, or much of it growth now depends on the ability of the company to go ahead and hike prices going forward.
Nikki, thanks so much for that. One of India's largest foreign institutional investors, Aberdeen, finds substantial value in emerging markets. Speaking to Bloomberg, Hugh Young, head of Asia Pacific Research at Aberdeen, said that he is now putting fresh money into Indian equities. Listen into a slice of that conversation.
We've been looking at a weakening global economy irrespective of trade war. Of course, trade war and the threats of trade war don't help that at all. It just makes corporates defer decisions, sit on the fence waiting for things to play out. We've seen the rise of populism around the world, which is, of course, leading to greater protectionism. Again, more threats to global trade, again, which affects the growth of the global economy. So I think there are plenty of concerns. Of course, there's still grounds to be optimistic as well. I mean, it's not all negative, and to an extent, markets have started reflecting that. I mean, our worry last year was that markets were shrugging off these concerns. I mean, it then hit markets quite badly towards the end of the year, and now they've stabilised. I guess that's the way markets operate. Bouts of enthusiasm followed by sort of distress and then a recovery of confidence. And we're seeing confidence recover slightly, but will that be dented with some of the full-year earnings? Quite possibly. And more importantly will be to see how companies start talking about this year as a whole and the outlook for this year. But I mean, our best guess is that it will be a slightly dampened outlook for this year.
Hugh, I mean, the weakness in the US dollar, a dovish Fed, a resolution in a trade war, they're basically the parameters that many people have said would be setting up for a revival in emerging markets, right? I want to throw up this chart looking at volatility, because at the very least, after what has been a torrid few years for EMs, we're looking at volatility across emerging markets, actually at the lowest versus developed markets since 2013. So, you know, is this going to be the year where we see a resurgence in EMs? If so, you know, what's your top picks, and does a sustained strength in the US dollar throw a spanner in all that?
Well, of course, as a long-term investor in emerging markets and also in developed markets, one's always looking for that good year of performance, and certainly the relative valuation in emerging markets is attractive, and there are some fabulous companies in emerging markets and still some decent growth prospects, almost, I would say, irrespective of what goes on in the world. So some of the fundamentals driving the Indias of this world, for example, are still very, very attractive, whatever goes on in the wide world outside. So yes, I would say optimistic about emerging markets, but as we all know, in any given year, they're very prey to the fear and greed. So if people start worrying about markets, they pull money out of emerging markets. Again, it's almost irrespective of the long-term prospects of those markets, which of course for investors like us gives us great opportunities. We're very comfortable investing in areas where people are deserting, again providing the fundamentals remain good, and the relative valuations, as I mentioned earlier, of emerging markets are at a deep discount to many of the developed markets.
What about the Indian markets, Hugh? Because geographically, China obviously takes the top portion, and then the second largest geographic holding is really Indian markets. Do you expect that gap to close in terms of opportunities arising?
India has been a major exposure for us for probably around 20 years. So we've been overweight India for that length of time. We're still overweight India. One of the issues with the Indian market has been not so much one of quality, it's been more one of valuation. So it's been an expensive market for quite a time. Again, for us, the pullback that we've seen, quite sharp pullback in the Indian market and in the Indian currency, has given us confidence to add here and there, whereas previously we've been taking money out of India.
In global news, US President Donald Trump is open to extending the March 1st deadline on Chinese tariffs if the two sides are near an agreement. Remember, a US delegation led by Treasury Secretary Steve Mnuchin is in Beijing for the negotiations. Tom McKinsey of Bloomberg News reports.
more positive tone from President Trump himself. As you say, Stephen Mnuchin and Robert Lighthizer are in Beijing, ready and preparing for those talks with China's Vice Premier Liu He. It's interesting that Trump talked about the potential of extending this deadline because from the Chinese perspective, ever since this meeting at the G20 between the two presidents, China has made a big effort at trying to downplay this 90-day deadline. In fact, there was an op-ed running around some of the state media outlets just in the last few days suggesting and maligning the Western media's obsession with this 90-day deadline and suggesting that maybe it could be pushed back to March, April, or even further back. Listen, the Chinese priorities are, of course, to remove or have removed the tariffs that are already imposed on Chinese goods, and then the threat of additional tariffs, they, of course, want to get that nixed. But I think if you talk to China analysts and China watchers, seasoned China watchers, they would caution against any expectation of major changes as a result of this deal to China's economy, structural changes. There's simply no sign of that from China's leaders. And of course, you have to bear in mind modern Chinese history as well and the way that that threads into the thinking of the Chinese Communist Party. We can put aside the question of buying more soybeans and LNG from the US. That's not that consequential at this stage, at least when it comes to the bigger issues. I think in areas where China could move the needle are around market access. So you've already seen, of course, some sectors here and moves to open up some of the sectors around autos and the financial sector. China might point to the fact that Tesla, for example, is the first foreign automaker to have a wholly owned manufacturing plant being built outside of Shanghai. They could dangle that as a carrot. So you could see further moves to open up additional sectors and markets here in China, reduce the caps, reduce the need for JVs, because that's in line with the direction of travel for China anyway. You've had some moves from the Chinese as well to bulk up their intellectual property regime and some discussion about maybe some cosmetic changes around the Made in China 2025 industrial policy. But I think really it is market access that we should be looking for.
That's a wrap on this edition of Power Lunch. Thanks for watching. Lots more coming up.